Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Good morning and welcome to Wealth Coffee Chats. This is Tax Tuesday. My name's Anthony Wolfenden. I'm representing the tax business here this morning, and we're going into phase 2, chat 2 of a conversation started last week about a topic that hits most property investors, capital gains tax. A surprising little tax that can come and sting you very badly. Just as a bit of a refresher on what that is if you're very successful with your property investment and you exit as part of a retirement plan or some other plan, the government will love you to share. Good morning, Courtney, Megan. Would love to share in your wealth. And so what they do is, remember, it's not actually, as a refresher, capital gains tax is not a capital gains tax. It's actually an income tax. And if you own the property personally, they will take whatever gain you've made. If you've owned the property for more than a year, they will divide that by 2, and they will add that number, whatever it is, between the amount you sold it for, the amount you purchased and acquired it for, whatever that difference is, divided by 2, add that to your income for the year, as though you had earned all that money in 1 year. And you'll be taxed at marginal rates. That can lead to some surprisingly bad outcomes, which I actually want to go over today. Now, because it is an income tax, it is subject to management. So we discussed this last week. When you go to sell with a plan, speak to your accountant or your advisor before you list. You do actually need to get a clearance certificate now from the Australian government when you sell as well to indicate that you're a resident. If you don't, 15% is withheld by the ATO. So that's a whole other topic we'll cover another day. But let's just say when you go to sell and list a property, there's certainly considerations you want to make with respect to the ATO to manage your capital gains tax. Now, let's just look at it worst case. If you have most of the gain in the top marginal rate, if you've owned the property for more than 12 months, you pay 47% of 50% of whatever the gain is. And just to sort of make sure we understand this at the top level, that means that worst case, when you sell a property and make a massive gain, hopefully, the Australian government will take at most 23.5%. That's 50% times 47%. That's 23.5. I got those numbers right. And so they're going to take about a quarter. Great. It's good to know that going in, but we can actually use tax deductible expenses for whoever owns the property to reduce that gain in the tax year. So if you list, sell, and receive the funds in the same financial year, again, don't sell near the end of the financial year. Leave yourself time so that the property settles, because the capital gains tax event is when you ink the contract, not when you settle. You want to leave yourself time to take advantage of some of these techniques we've got for reducing your exposure to the tax. So I'm going to run through them briefly this morning. First thing you want to do is hold the asset for more than 12 months. The general discount of 50%, if owned personally, only applies when the asset between contract purchase and sale has been held for more than 12 months. If you're flipping and doing things like that, there are some other techniques. Morning, Kang. Morning, Luke. Welcome, guys. We're just getting into how to reduce capital gains tax. The other thing you can do is you can offset capital gains with capital losses. If you are holding anything that's made a loss and you are looking to exit anyway because that particular asset, whatever you've got, is never coming back, then sell it in the same tax year and the loss will offset the gain. I've had some people do that with crypto portfolios and share portfolios. So that can be quite good. You can also prepay expenses. So the government considers it good tax and income management if you've made a lot of money and the money's sitting in your bank account because you've sold the property, as an example, and you have expenses for running other investments. They will let you bring into this tax year up to 12 months of future expenses. That's just good management. That's allowed. Don't try and pull in 3 or 4 years. They'll consider that a tax dodge. Morning, Jeff. But they will let you bring forward up to 12 months. So prepaying property management, prepaying property expenses. Make it expenses, don't make it things that need to be turned into a depreciation schedule or depreciated over time, but certainly prepaying any deductible expenses for the next 12 months is good. Now we're going to run through an example a little later in the session, but utilising superannuation. This is a really powerful way to reduce a gain. As most of you know, you can contribute personally money to super up to $30,000 per year tax deductibly for most of us. That comes from superannuation guarantee, salary sacrifice, or money you just send to super. Super's tax rate on contribution is 15%. If you're in the top marginal rate for a capital gain, you could be paying 47%. So I'm not really good with numbers, but there's a 32% difference in there that you could take advantage of for some of the gain. So this is one of the most powerful techniques, and I'll give you an example, as I said, in a little bit. There is a little sting in that tail with the ATO called Div 293. Look that one up. I'll cover that in another session. If you're a small business owner, there's small business concessions. If the property is owned in a related party to a small business, you can strategically time the sale. For instance, in a low tax year, you might have low income. You might be retiring. You might be retired. So making sure you time it, that's another way of reducing it. There are exemptions for your principal place of residence. And of course, you can also have property held in different structures that have different tax rates that can be used to your advantage too. That takes a little bit more long-term planning, but planning is what we're all about, isn't it? When you enter any sort of investment, any sort of relationship, any sort of business, you should have the exit strategy in mind. Doesn't mean you'll get to execute it because it is a plan. Plans change. But if you get into a property knowing what the likely outcome is going to be, how long you're likely to hold for, etc., you can use entities and holding entities to optimize your tax outcome if you stick to the plan. So they're the major means of doing it. Now, what I wanted to do is just run over an example of what can be done, and I'll use the superannuation example because it's the simplest. It's the one most of us have access to. And so we'll just run over this. Let's imagine we've got a client. The client, example individual, earns about $130,000 per year. With income tax and Medicare levy after stage 3 tax cuts, that individual is going to pay about $33,000 in tax. It's literally right on 33, just under. So that's going to go out the door in any given year. Now, let's consider that they're selling a property and they've just made a $200,000 gain. It's not particularly large, okay, but it's going to make a big tax difference. So let's run through it. If they've held the property for more than two years, they've made a notional gain of $200,000. They would get the 50% discount, the 50% general discount, which would mean that the gain, as far as the ATO is concerned, is $100,000 taxable gain. That will be added to their taxable income. So their income that the year of the sale won't be $130,000. It will be $230,000. That does put them in the top tax bracket for a good portion of the gain. And that means with income tax, Medicare levies, their total tax bill would jump in the year of sale from $33,000 to $74,000. Okay, so it's gone up, and notionally the capital gains tax on that exit event is about $41,000, right? And that's sort of like the numbers I mentioned. So the 50% discount, top marginal rate 47%. This is a little bit under a quarter because not all of the gain was in the top marginal rate, but roughly a quarter. $200,000 gain, $41,000 in tax. It's heading up towards sort of the 24% level, really. Now, what could that individual do if they had been putting regular amounts of super away? There are carry forward rules that allow people to bring into this tax year any contributions tax deductibility they've not used for up to 5 years previously. For many people employed in standard types of roles in Australia, that might mean they've got over $100,000 that they could put into super in any given year. That's a nice boost. That's another topic we'll cover for another day, but super, you're playing the tax game of 0 and 15%, not the notional tax game of 25 or 30. So there's lots of advantages to plunking money in. But let's say that they did do that under that sort of arrangement. $200,000 made, $100,000 taxable, $100,000 could be placed straight into super. Super would take $15,000 in tax because the gain is completely eradicated from the individual making the contribution. Their notional tax is back at $32,000, as it would be without selling the property at all. And if you look at the difference there on the total tax of $74,000 versus the case of the super contribution of 32 plus 15, sorry, going into a bit here, total tax savings there is about $26,000. So what they've managed to do by looking at parking some of the money in their super, which they won't be able to touch till retirement, but that's okay, is they've reduced their capital gains tax bill from about $41,000 by 26. They've saved 26,000 total tax dollars. That's over half of what the nominal capital gains tax was for the unplanned event. That makes a really, really big difference. Now, here's another example. What would happen if they waited until retirement? Well, they wouldn't have any tax in their own name. They could contribute the gain to super. You wouldn't do it all that way, but basically there'd only be $15,000 tax total, very worst case. So there's lots of ways of saving money. So $26,000 saved on tax on a $200,000 gain, obviously with two individuals owning property and some of the larger gains. It's quite easy for a client to save, for a couple, to save almost $30,000 each on capital gains if they plan for it. So that's what we're here to do. That's basically what a good accountant or a good financial advisor would do. As you go to sell, the hints are, as you list or as you prepare to list, talk to your accountant about the notional gain that you expect, get an idea of what the property will sell from the real estate agent, share that with your accountant, calculate the capital gains tax, come up with a plan to reduce the tax in the financial year that the contract is signed. Don't forget to reach out to the ATO and get a clearance certificate for the sale so that they don't withhold 15% of the sale price, thinking you're a foreigner, and have a good plan. Sell with confidence, sell with your outcomes known. What we'll do is we'll wrap that up there because we've gone a good sort of 15 minutes so far. We have lots of good events coming up for Wealth Coffee Chat Tax Tuesdays. We're going to chat a little bit about super, and we'll probably delve into some of the div taxes. These are the nasty little surprises that the ATO and the federal government have set up to share in your wealth when you do very well. and we'll probably cover Div 293 next time.
Thanks for watching another.
I was just going to say, thanks guys for attending Tax Tuesdays. We'll see you next time.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.